From an economic point of view, the biggest concern for the broader electorate, and investors more specifically, going into the U.S. presidential election may not be the differences between the two primary candidates, but their similarities. We're going to talk about what neither of the candidates are willing to today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. In many areas where Vice President Kamala Harris and former President Donald Trump have differed most significantly, Kamala Harris has recently pivoted from earlier positions, and she is now much more closely aligned with her rival. But let's examine a few of the most fiscally or financially significant things that the former senator has proposed in the past, and think about what the economic implications of those would be in the event that those happen to come along. And then we're going to talk about some other things too. So first thing I wanted to talk about was that in 2019, then Senator Harris co-sponsored a Medicare for All bill with self-described Democratic Socialist Senator Bernie Sanders. Now, the Urban Institute, the Mercatus Center at George Mason, the RAND Corporation, the CRFB, which is the Committee for a Responsible Federal Budget, all estimated that the 10-year cost of Medicare for All would probably fall somewhere between $28 and $36 trillion over a 10-year period. It's interesting that they all should align on those numbers. There have been some organizations that have come out more recently arguing that those overstate the estimated costs, suggesting that, among other things, they don't factor in any potential cost-saving benefits. That could be true. I would simply push back on that a little bit by pointing out that cost savings and efficiency are rarely terms that come to mind when I think about government programs. But what is interesting about this is that the current net present value of the unfunded liabilities associated with our existing Medicare program are just under $42 trillion. So that's essentially the net present value of the obligations to which the government has already committed itself associated with the Medicare program as it exists today. So to imagine that you would expand Medicare to Medicare for All from its current arrangement, it doesn't seem so implausible to come up with a number of the neighborhood of 30 trillion. In fact, it might seem conservative when you consider that all of the existing Medicare beneficiaries, current and future anticipated, that the net present value of that liability is about 42 trillion. Okay, so let's just keep that number on the side for a moment. We'll call it 30 trillion, round numbers, or pick a number, but that's basically the order of magnitude we're talking about. She also touted her tough on crime record when she was a prosecutor and attorney general for California. When the defund the police movement sort of got going, she supported a lot of those progressive reforms, like ending cash bail and things like that. Presumably defunding the police would reduce costs somewhat, but it does seem that both she and those that had previously supported it, probably due to an uptick in crime in some of the areas that where that policy was most pronounced, that I think that's kind of gone away. Besides which, when we compare that in terms of its cost with some of the other things we're going to be talking about, it probably isn't hugely important. But there is another proposal that came from other quarters that does have costs that are comparable with those for Medicare for All. So Kamala Harris was, among other things, a vocal supporter of the Green New Deal, which is probably more closely associated with AOC, the congresswoman from New York. The thing that I would point out about this is that the estimates for the cost of a Green New Deal vary much more broadly than the estimated costs of the Medicare for All plan. So some progressive think tanks have estimated the cost of the Green New Deal at somewhere between $10 and $20 trillion, and some conservative think tanks have estimated that the cost would be closer to $51 to $90 trillion over the course of 10 years. So we have a much bigger range. What I would say is that if we take the upper end of progressive estimates and the lower end of conservative estimates, and then just took the midpoint of those two, that actually turns out to be approximately 35 trillion. And I only point that out because it happens to keep the math easy. Our current federal debt is approximately 35 trillion. The cost of Medicare for All is approximately 30 trillion. The estimated cost of a Green New Deal is estimated to be, a much wider range, but we'll call it 35 trillion. So that's sort of right in the midpoint. Now, I want to touch on this a little bit more, this Green New Deal bit, because how you estimate that cost is going to be associated in part with more specific policies like a federal ban on fracking. So in 2019, Kamala Harris stated that there was no question that she would support a federal ban on fracking. And because we like to use numbers on this stream, I want to just put some numbers on that. I'm going to be looking over to the side here periodically because I had just taken some notes ahead of this. But I think it's important to understand that the United States is the world's largest fossil fuel producer. So Saudi Arabia is now in second place. And as we think about that, we should also realize that more than 60% of our oil and gas production comes from fracking. So when you think about that, you begin to get some sense of the scale of things. So I'm just going to go over here. So we produce, so I'm using all of 2023 numbers for Saudi Arabia and production numbers through the end of July of this year for our daily calculations. But we produce, in terms of crude oil, the roughly 12.85 million barrels of crude oil per day in the United States. Now, we also produce, in terms of an equivalent amount of energy, close to 18.4 million in dry gas, and another 4 or so in liquid gas, propane, that kind of thing. That compares to just under 12 million barrels a day for Saudi Arabia. So to put things in perspective, if you figure that our effective energy production, so we're talking about crude oil, dry natural gas, and gas liquids, is north of 21 million barrels a day equivalent. So I think through the end of July, we had produced 15.8 quadrillion British thermal units of energy between those three categories. Banning fracking would effectively be equivalent to taking the oil production of Saudi Arabia, the world's second largest producer, offline. So to think that's not going to have a cost would obviously be quite naive. So how much of a cost would that have? Well, according to Jerome Powell, he believes that inflation is impacted by about 0.2% for every $10 per barrel increase. And EIA estimates figure that taking that much oil offline would be an increasing cost of about $20 to $35 per barrel. So you're talking about that alone would be a 70 basis point increase in the inflation rate. Higher inflation, higher rates. And of course, that's just factoring in the inflation rate. It's going to have carry-on effects all over the place. You can imagine almost anything that involves logistics in any way. Everything, and also housing costs, and not just housing costs in terms of building, because materials costs would be higher, all of those associated energy costs, but even just utility costs. Heating oil in the Northeast, which is where a lot of people heat their homes. So why do I bring all of this stuff up? So everything that we are talking about, whether there are things that Kamala Harris has proposed in the past and since reversed on. So there is some chance, we can assume, because she has talked about eliminating the filibuster, ostensibly for Roe v. Wade. They have talked about adjusting the construction nature of the Supreme Court. But I think we can assume that people's policy perspectives, because she has said repeatedly her values have not changed, that she might take advantage of those circumstances, assuming she had Congress that was in alignment with her, which is not necessarily a given by any means, that some of these things could come back on. They're highly inflationary, and they're going to cost a lot. But what's interesting in all of this is that former President Trump, although he has not proposed these things himself, hasn't done anything to talk about addressing our debt, our federal debt, and our fiscal budget deficit. And the problem here is that these things are inflationary. So and we've seen that, but basically if we continue to see very high levels of fiscal deficits, and right now the fiscal deficit is nearly 7% of U.S. GDP, inflation is something that is going to remain a problem for some time. And I don't see either of these candidates really talking about it. And I can kind of understand that, because one of the things that's not particularly appealing is to tell people, rather than, I'm going to give you something. Brian Sullivan just tweeted, I thought it was rather funny. He said, politicians are promising everybody a pony. Made me think of the Seinfeld episode involving a pony, if any of you remember it. But it does lead me to believe that we could potentially actually see inflation rebound regardless of who gets elected. Now, you will not be able to hear what is on my screen, but I put the closed captioning on, so I don't know, producer Jay or Brad, you guys can get into my ear and just tell me whether or not anyone's going to be able to see what's on the bottom. But Janet Yellen was being interviewed recently. She was meeting with the press, and she was asked about what could happen to the dollar. Could the U.S. dollar lose its reserve currency status? Now, this is actually just intended to be more funny than anything else. But I want you to pay attention to if you look down at the bottom of the screen here, you can see this Department of the Treasury sign that she has on her lectern. And a reporter's asking her a question about the reserve currency status of the dollar. Watch what happens.
And over a longer time horizon, how concerned are you about the potential impact of the dollar status as the world's reserve currency?
I don't know if you caught that, but right around the time that she was asked about the reserve currency status of the dollar, the Department of the Treasury insignia, the logo, that seal that was on her lectern, fell off, startling Yellen, but it was about as perfectly timed. I've been looking around. That might be becoming a viral video somewhere. If you can find it, I highly encourage it. So where does this leave us? Basically, my view is that neither candidate at this point has come forward with any meaningful plan. They're not even addressing it, frankly, in any meaningful way. Talking about the fact that we have big fiscal deficits, a huge debt, and that we really need to do something about it, or there will be an impact. And if they don't do something about it, and neither of them seem inclined to, then we have to assume that inflationary pressures could resume. And if they do resume, what then? Well, those of you who follow Fast Money, who've seen me on that show, will know that at the beginning of the year, we all had to come up with an acronym. What are our best trade ideas for the year? My acronym was BRAVE. And the things that were in that were Bitcoin, which, as you could probably guess, is intended, among other things, to be a hedge against inflation. The A was actually for AU. So from the periodic table, I was using that somewhat liberally to represent gold. R was for real estate. I was talking about, among other things, distressed RMBS because I figured there would be a rebound in that. But let's just think about that as real estate. E was for emerging markets and V was for value stocks. And it's interesting because here we find ourselves only 2 months from the end of the year. And I was thinking, what about those things that I thought were important last December, early January, are no longer? And I can't think of anything. I think that these are still the places to be. So gold, we're talking about precious metals, real estate. I think value stocks, which you could use a proxy such as RSP, for example, which is an equal weight for the S&P, would be a way to play this. And if you're long Bitcoin, did I put that in correctly? I think all of these remain decent places to be. So there are also ways to just play the value trade if you chose. But, this is the S&P 500 stocks equal weighted. And I think you do end up with much more of a value over growth tilt if you're in this. So I kind of wanted to start with that because we have the election coming up next week. And I think it's, I've said on many occasions that I thought that the markets seem to favor Trump, equities seem to favor Trump, and they're behaving as if he has a decent chance. That's my read. But I did think that it's important to really pay attention to the sort of the big driver. And the big driver, I think, for us is going to remain inflation I think that could come back to haunt us. Now, there are some disinflationary or deflationary effects going on, which I should point out. We have a demographic situation in China, and obviously some softness and a bubble there that took place. That is disinflationary or deflationary globally, which is certainly helpful. Although, this is not the kind of inflation capping impact that one hopes for. You hope that what is helping to keep a lid on rising prices is increases in productivity, not bubbles bursting around the world. That's not a good outcome. Even if, one of its side effects we might view positively. But I figured I'd just point that out because I wanted to just say, look, I haven't really changed my perspective a whole lot since the beginning of 2024. And it's going to be a big week next week. But either way it goes, I think these things will remain true. So we will leave that there. And again, ways to play it: real estate, Bitcoin, gold, value stocks to a degree, because I also suspect that if we get an uptick in rates, we saw this before. So in 2022, the market rolled over. We went into a formal bear market as rates rose, and if inflation rears its head, then interest rates will rise. Oh, and that leaves me with one other thing, which is that, and I've said this before, you don't want a lot of duration. If you want to know what really gets punished when interest rates go up and inflation rears its head, look no further than long-dated treasuries. Sometimes called risk-free, they're anything but risk-free if inflation comes back. And we're just going to take a quick look at the peak to trough here. But if you had long-dated treasuries, you lost more than half your money between March of 2020 and October of 2023. 54% drawdown on a price basis in TLT, which is the 20-plus year treasury. So you don't want a lot of duration, and clearly that is not risk-free. So just keep that in mind. And with all of that said, I wanted to address a question that I saw that FinWest had about Capri, because I don't think we talked about this last week. So several weeks ago, let's go like this. Corey Henderson, yes, short TLT, yeah, it is working, and it will. And believe me, if you think it's been working now, just wait. If we get an uptick in inflation, that could really, really be punishing. So I'm going to get to as many of these questions as I can, but we'll just deal with that one at a time. Okay, so Capri. Let's talk a little bit about Capri. So for those who don't know, Capri had agreed to be acquired by Tapestry. And a little while ago, I'm going to say it might have been as much as a couple of months ago, we saw a really big risk reversal trade where an institutional trader, and this was highlighted actually, it was brought to my attention by Karen Feinerman, that somebody was basically speculating that the deal would go through. Well, last week, what happened? They got an unfavorable ruling, and basically we're told now the deal can't go through as it's currently stated. So what ended up happening was that Capri got annihilated. So Capri is the target, Tapestry was the acquirer, and the stock fell significantly. So if I did not push this out there, so this is the no 22.5 short put, no 45 long call. So here's the thing. The flow that we saw last week, interestingly enough, was actually mostly upside call buyers. So January, the contract in here that had the most activity on Friday was opening buyers of the January 2025 25 strike call. So January the year 2025 25 strike call. That was the most active contract. Now, that saw opening flows. There was a lot of activity in 35 and 25 strike puts, but those already had a huge amount of open interest. So that was largely profit taking from those who either had bet that the deal was going to go through, or those that had not. But those things were in the money. It's not common to see a lot of opening activity in 65, 70 delta put options, and there was already a huge amount of open interest. So we know with a decent degree of certainty that a lot of that flow was very likely just people closing out existing positions. So if you were in that risk reversal, that was the no 22.5. So short the 22.5s, long the 45s, betting that the deal would go through, and it did not. Now those no 22.5s are in the money. So you could have the stock put to you at 22.5, which is about $1 higher than the stock's current price. So let's just say that in terms of the current stock, you're going to be down about 5% on that trade. Now, why is this doing that? Okay, doing this. All right. So what now? Well, my take on this is that we've had that reset in price. And I think there is still some opportunity here for Capri. Is it going to be a deal that looked like it did before? No. I have to also say, I'm pretty surprised by this ruling. I mean, it just seems like a strange place for the administration, for the FTC, the DOJ to be focusing their time and attention, frankly. Because what we're talking about are handbags from Coach and Michael Kors and the like. And it seems, of all of the things where you're going to be sitting there trying to protect consumers, it strikes me as a strange place to focus government resources. By the way, they are focusing government resources in areas that do make sense. So, for example, as I discussed last week, they are looking at Apple. Apple controls 60% of the smartphone market in the United States. So if you're looking for a monopoly, it makes sense that you would be taking a look at the largest publicly traded company, one of the most profitable companies that controls more than half the market. So now whether they technically represent a monopoly, I will leave it for others to decide. But it is clear that they are focusing some of their attention in an area that probably does deserve some scrutiny. But this certainly seemed like a strange spot. So if you decide to take delivery of the stock and own it at 22.5, there is some call skew in this now. What do I mean by that? What I mean is that the upside calls, at least when I was looking at this before, we're trading at a premium to the downside puts, which would make something like covered calls more attractive. Let me get rid of this one, and let's see if we can... So there was a significant amount of call skew. This isn't quite as skewed as it was before, but my point is that oftentimes you get kind of more of a smirk where as you get down to the at-the-money call options, it's a little bit lower, and then starts to drift up at the upside. Here you can see that actually the upside calls, so this is the at-the-money strike, actually are trading at a decent premium. So one thing you could do if you take delivery of the stock is then start taking a look at selling some covered calls and getting some of that money back. If you are selling covered calls against stock, that's functionally equivalent to selling puts. But a big upside move here seems unlikely. It's not going to get back to 40 now because I don't really see anybody else stepping up to deal with it and take over net of this tapestry thing, and that probably is going to play out for a while. But that might be a way that you could deal with the trade now. You can also, look to close that trade out at a loss. Again, I'm guessing that's probably worth sticking out until November expiration because it's less than a month away and the implied volatility is high. So the rate of decay on those short puts is pretty high as well. But effectively, once you get put the stock, you're short puts right now, you'll be put the stock, sell calls, and that's essentially rolling a short put position into a synthetic short put position, which is what a buy rate is, or a covered call. Okay. PC, Mike, no one is banning fracking. Election is not only about the economics, it has a lot more to do with continuing having democracy. Also, most economists have opined that her plans are better. So, all I'm saying is that in 2019, she explicitly stated that she was in favor of a federal ban on fracking. She also has since said that her views on this have not changed. She has also said that she would follow the law. Okay. But, of course, I think we can agree that the President of the United States may have a view on what the law should be and may even try to encourage a certain legal direction. Exclamation points about having to do with democracy. I'm not talking about that. I am simply talking about what would the financial implications of some of these policies be. And making sure that everybody is thinking about this not in a broad philosophical sense, but in more of a numerical one, right? All I'm saying is that the United States is the world's largest fossil fuel energy producer. That's a fact. You can get that from the EIA. You don't have to listen to me. And more than 60% of our production is from fracking. Whether you support fracking or don't support fracking is a separate issue. Whether you think democracy is at stake, that's a separate issue. We're just talking about what one of the candidates has said her own position is and what the implications of imposing a federal ban on fracking would be. You're talking about getting rid of more than 60% of U.S. oil production, well, oil and gas production. And the implications for global oil markets would be profound. It's as simple as that. So Michael Walter says, we've asked AOC to move to California so she could share her knowledge with you. By the way, California, California is a very oil-rich state, but we're not developing the state's oil reserves here. Oil and gas development is not something that's favored in the state of California. I think most people are probably well aware of that. We have more stringent regulations in terms of pollution than many places, and a lot of other states have decided to follow along. So we have something here called the California Air Resource Board, known as CARB for short. Many of you may remember there was a time when we used to have 49 state legal cars. They were legal everywhere except the state of California, which had its own emissions requirements. Now, many other states have elected, rather than trying to develop their own standards, which can be clunky, they've essentially decided to just rely on the California Air Resource Board to make determinations about things like vehicle emissions and then just tag along. So they say, well, whatever rules they come up with, we'll go along with it. I think there's 5 states total that are essentially following the CARB guidelines. And I think other states that are doing it include Massachusetts. It's probably northeastern states, Massachusetts, New York, and so on. It's not hugely important which ones they are, but yeah, there's definitely there are different perspectives on this, to be sure, but we can be sure that if you eliminate oil production that vast, it's going to have huge implications globally. And maybe you want those implications, that everybody, again, I'm sure there are some people who are hopeful that oil and gas prices shoot up because they're figuring that if they do, then we'll use less of them. And I'm sure that is also true over some period of time. But again, you guys can decide for yourselves how you feel about other issues. I was just on the phone for probably an hour with a friend of mine, correspondent with the New York Times, and we were talking a little bit about the election, and we talked about some of the different concerns that we have. She was also asking about somebody I'm acquainted with who seems to have joined forces on the Trump side and is taking a prominent role. So she was trying to get some background on that. This has come up before. I would just say this, that most of the people, I think, in financial services, most are probably Democrats, more so than Republicans. It seems unusual, actually, for people in really prominent roles to sort of step into the fray, especially at larger companies. They usually try to stay out of it because I think it's a risky thing for senior executives at companies, especially CEOs, to come out in favor of one or the other because only one's going to win. So if you pick wrong, that could certainly be a problem. Okay, so what do you think of Uber? Here, maybe discussing acquiring Expedia. How do you play this if it happens? Bullish. Yeah, so, between the two, I suppose I favor Uber. It just feels like they have a more secure market position. This is, I don't know if you can see my screen. Okay. All right. So if you can see this is a sort of a common refrain. We had a lot of companies that, for a long time, people said, "Oh, these things are insanely overvalued. Will they ever be profitable? They just chew up cash." Blah blah blah. Well, we can take a look and see that when companies are well positioned, they dominate their space, and they finally turn on the spigot of profitability, that things can change rather rapidly. So looking at full year 2025, $2.50 is a share, give or take, is what the street's expecting, and $8 billion worth of free cash flow. And they're only about $4 billion in net debt, is that right? Maybe a little bit more, closer to $6, I guess. $6 billion in net debt. So they're going to have enough free cash flow that's going to be offset quite significantly. So $2.50, we'll just call it $77, 2.5. So it's trading 30 times full year 2025 consensus earnings estimates, with big free cash flow growth and real earnings growth. That doesn't seem too terrible from my perspective. In fact, it's kind of interesting because I think last week we may have been talking about, I'm not sure if we did or didn't, Elf, which is the cosmetics company, and Estee Lauder. If we didn't, I can just mention it right now. In fact, actually, I'm going to do that. So, oh yeah, let me do the bullish play on Uber first, and then we'll get over to that. Oh, let's just take a quick peek. Also, we'll just see when their earnings are. So earnings are going to be on the 31st. I assume that's after the close. And claiming the implied one-day move is 6.5%. Let's see if that's true. Remember what I was saying before, that the implied move in some cases looked to be a little bit understated because longer dated implied volatilities were elevated a function of the election. So the implied volatility that was baked into the cake for the election. 275 and I'll just call it 275 and $3. 575 is the mean absolute deviation by weekend. So that's about almost 7.5%. So options seem very reasonably priced going into the print, as we say. We did have an 11% up move last time. And let's just take a quick peek at some of the technical indicators. Not mine. It's much easier to take a look at others. Somewhat split. Looks like a couple more of them leaning short here than long. Kind of trending sideways. Growing into its valuation might be one way to think about that, but okay. So I think a decent way to play this would probably be something like a call spread risky. Or, one of those strangle swaps that we sometimes talk about. Again, the key with the strangle swaps, and I was being asked about this earlier, but the key with the strangle swap is just make sure that the implied move that you're selling by itself isn't abnormally cheap, because that's going to make things a little bit screwy. And actually, let's just take a quick peek also and just see how the term structure looks and just make sure that it doesn't seem like the longer dated premiums are way out of bounds. But essentially, when you do something like that, what you're doing is you're selling this over here to buy something further out. And what would that further out be? We are looking at, you got to catch Feb. So we'll construct that one first. So we're going to do this. We'll do the strangle swap first. 7.5% implied move. So you want to buy the Febs, if it has them. It does. So we're looking at maybe, could be 72.5 up. Something like this, I guess. So you're going to buy both of those, and then you're going to sell near dated against it. You could even just do the weekly if you wanted. I actually personally think that probably makes more sense, because then you're taking out the issue of dealing with the election. So you'll own the election, not be short it as well. So that would look a little bit, and that is backwards. There we go. And that's that. There you go. So that's going to look something like this. And we could actually take, maybe I'll take that strike down a little bit here. Oh, no, because that's 1%. So actually, that's a good point. Oops, this has to be lower. This is not right. That was supposed to be the 82s or something like this. There we go. All right, so just a quick point. Notice that these November 1st 72 strike puts are 72 cents at the midpoint. I don't like to sell options for much, for less than 1% of the risk. And so the risk is that you get put the stock at $72. That's 1%. That's 1% in a week, actually. I mean, I'm usually looking at it on a monthly basis. So in theory, you could use a lower strike if you chose. But you also have to remember that depending on what your costs are, what your broker charges, you could be contending with, this should be a lower strike also, by the way. So it's going to look more like that. But spending around $5, which incidentally is not far off of the implied move, but you're going to be net long premium, right? So the amount of risk you're going to be taking with the stock, at least according to the options market right now, is 7.5% of $7.5, right? So you're looking at $5 and change of risk, higher or lower, even if you were just going to play it straight with stock, long or short. So here you aren't really taking the same amount of risk, because that's the amount of premium you're laying out, but you're not going to lose all of that. It's not going to go to zero. And you can potentially make money in either direction. And if you want to skew this to the upside, which I suspect you do, based on what you're saying, then you can bump this strike up a little bit. Here, this is still 1%, right? So now we're getting there, even maybe a little bit more. There we are. So you can just play with those strikes a little bit. Your mileage will vary. The stock's going to be probably in a slightly different price when the market opens tomorrow than it does right now. But that would be a way to play it. Another way to play it, if you were just interested in getting long the stock or just getting exposure to it, would be with a call spread risk reversal. For those, and I'm just going to use November expiration for simplicity. So what do you do there? You buy a call, you sell a further out of the money call, and then you sell a downside put, trying to do this thing in round numbers for something close to even money. So let's go down, take a look at this implied move, but maybe 73, 78, stock 77, close to 78 there, but I want to capture more of that upside, I think. So there, and that was pretty close to even. So there you have it, if you're just using November 15th. And so you get participation for, the first $5 or so, not quite $4.50 to the upside, but remember, we're talking about an implied move of around $5. So basically giving yourself that kind of a buffer. So I'll skip the first $5 to the downside, and I'll gather the first $5 to the upside. Do this only when the implied move is at least as high as you anticipate it will be, though. Options are really cheap, then just use a call spread, something like that. Okay. I was about to talk about something else. I was going to pivot to it. Oh, yeah, I was talking about ELF and Estee Lauder, but let me get to a couple questions before I move to that. So, can see one line of text. Oh, I'm assuming that's one line of text for the closed caption from Secretary Yellen. So, basically, the gist of it was the reporter said, what do you think about the possibility that the U.S. dollar could lose its reserve currency status? And almost as soon as the question was out of the reporter's mouth, the Treasury sign fell to the ground and startling Yellen. I just see if you can find it. It's a riot. Makes you wonder whether there's some divine power up there sending signals. Okay, Medicare spends 90 cents for every dollar it spends on actual healthcare, while private insurers spend only 61 to 65 cents on actual healthcare for every dollar they collect. Yeah, so interestingly, one of the criticisms of the Medicare for All estimate that the Urban Policy Institute did, and that's a left-leaning organization. One of the criticisms that it received was that it did not account enough for the lower administrative costs that Medicare would have. Possibly. But look, here's something else to think about. I mean, with that, there are socialized... We have socialized medicine in other Western countries, right? So you have it in the UK, you have it in France, most of Western Europe. And it has some benefits, and it has some things that are not great about it. You know, the question is, how much government do you want to have, right? So government right now is about 40% of GDP. And if you increase this, let's just say for the sake of argument that it's $3 trillion a year. Okay, so 10% of GDP, which is, I mean, you're talking about saying, okay, what portion of healthcare is the government going to control relative to what it does now? Well, if it's 10% of GDP, let's say call it half of that. Okay, so if it's half of that number, then that's $1.5 trillion a year, and that means that federal, that the government role in the economy moves from 40% to 45%, and it doesn't take much to get another 5%. So if you get to a situation where if you have an economy that is mostly government, okay, rather than mostly private. So we're about 60% private now, 40% government. Compare how people do in countries where that relationship goes the other way. And, we all want to have things. We all want fairness. But everyone's going to probably draw that line in a slightly different place. And we'll point out that sometimes when government is most of the economy, when most of what happens in your life is government, it doesn't always turn out so hot. That would be my general point of view, but I will also concede that our existing system of a hybrid of various government healthcare insurance programs, which includes state-run Medicaid and federally run Medicare and all of the private insurers and hopping back and forth. What a lot of you probably don't know is that I, along with my brother, actually worked for a nonprofit organization for a number of years coming straight out of college, and we saw the administration of government efforts firsthand. In Medicaid specifically, we didn't really deal with Medicare, but we dealt with Medicaid. And, it's not all sunshines and rainbows. I'll leave it at that. Okay. Is there a way to maximize a holding in Viking? Did sell one November 15th call at 95. This is a question from Greg Forrest. Greg, if I could trouble you to elaborate by what you mean maximizing your holdings, because if you're selling a 95 call, that's not increasing your exposure to it. I'm assuming you're long the stock and you're selling 95 strike calls against it, maybe. I'm going to wait for you to come back to us on that one, because it's not quite clear to me what you mean by that. If you were looking to buy long-term SPY puts, how far out, what and when would be optimal? Okay, so this is from BT. He's asking about SPY puts. As many who've watched this before will know, I have often talked about using SPX, which is functional equivalent. Right, so it doesn't really matter whether you're using SPY, IWM, diamonds, Qs, SPX, NDX, and so on. So let's just see what we have here. So I like if it was just outright puts, and if I have specific catalysts that I'm targeting, or if I'm trying to look out beyond a certain point of time. What might that point of time be? How about the end of the year? So we obviously have the election. That's a week away. Still have a lot of earnings coming out, so those would be things to target. But why would I look out to the end of the year at this point? And the reason is because oftentimes I think people would prefer to at least have the option to defer a taxable gain if they could, right? And if you use options that expire before the end of the year in a taxable account, and I'm not offering tax advice, like I'm not a tax attorney, I'm not your accountant, but I just think this is something important to think about. Just bear in mind that if you use an expiration that does not carry beyond December 31st, you may be compelled to act and incur a tax consequence before the end of the year. Maybe that works for you. Maybe it doesn't. The markets are higher. Maybe you don't have a whole lot of offsets in terms of losses. So this would be the time to start thinking about paring off your gains and losses so that you can deal with the positions that you want, but that's something to think about. So I like generally to use 30 delta puts when I'm looking at SPX. So what would a 30 delta put in SPY look like that goes out beyond the end of the year? So I'm going to just put bearish in here so it switches to a put. I'm going to modify this. I'm going to punch it out to just January because I think this is simple. And, you know, a 30 delta option is going to be something like these 565s. 565 puts, which cost $10 right now. Now, the rate of decay on these is not going to be too great, but, you know, $10 is not a cheap option, but don't forget that that's $1,000 for every 50, you know, call it $56,500 worth of insurance that you are getting, right? So when you think about it that way, it's actually not all that terrible. Also valid would be using put spreads. I like to keep put spreads a little bit shorter. This going out 80 days. So that's the tricky bit, right? Because if you put on a put spread, your ability to monetize that perfectly in the short term. So if we get some kind of a washout between now and Christmas or something like that, a put spread's not going to offer you quite as much bang for your buck as an outright will. So those are kind of the trade-offs to think about. If I was going shorter dated, I might use a put spread and I'd probably just monetize it. If I was looking for just an outright put as protection against a portfolio, I'd probably want to push it beyond the end of the calendar year, pick a 30 delta, and then look for either opportunities to spread against that or monetize it, that kind of thing. Okay, so Greg Forrest, it looks like you're getting back to me on the Viking thing. So you're long stock selling covered calls. Yeah. Okay, so that makes sense. Acquisition or perhaps they partner. So what's interesting here, not a bad play, by the way, for an acquisition. I will even take this one step further and say that this merger arb isn't such a thing anymore. Or at least it doesn't get as much time and attention as it used to. This was, this was the big thing to do in the 1980s and actually into the 1990s, which was there were the merger arb shops. Those were the desks that were, speculating on merger arb deals. And then you also had risk arb guys that would try to, sometimes suspiciously, successfully too, like the Ivan Boskis of the world, sit there and try to say, okay, let's pick out stocks that we think are going to get taken out. If they're getting taken out for cash, being short, longer dated, reasonably far out of the money calls works out well, because if they're getting taken out for cash, then the options effectively just go away. If they are acquired for stock, though, it doesn't work out quite so nicely, because what ends up happening is that the stock usually converts into the acquirer's stock, and so you don't see that crush. All the premium doesn't get sucked out immediately. So that's one quick point. Although, in something speculative like this, so if you're looking at a pharmaceutical company or something similar, a one-trick pony, pre-revs, you will see that the acquiring stocks will almost always have a much lower implied vol. So you will get a big vol crush, but it won't get knocked out completely. But I like the strategy of being long the stock and selling upside calls when you have situations like this, because you're selling 95s against a 75 stock. So you have a decent bit of upside. So I think that's a decent way to play it. And actually, of course, call spread risk reversals also would be another way to play it, because it ends up with a very similar sort of dynamic, but you get less immediate downside risk. So you still get that same upside participation, but the downside risk would be more muted. Bearing in mind that the tricky piece in all of that is that you don't always get the liquidity that you'd really like, right? So you might get fairly wide spreads, and that becomes a little bit more of a challenge. But, what might something like that look like? You can see here, that's $65. So that's, and maybe I go down to the 95 strikes that you had on. So this is very close to zero cost, this one here. So you have very minimal participation down to the lower side $60 strike that I was just talking about. And we did get that pop recently. So I'm looking back in around this level on the chart. So you get most of that participation and you alleviate some of that. So it's a strategy I like in these contexts when you have really, really high implied vol. Okay. Let's see what we got here. Tesla gapped from 240 to 220, and after earnings last week, back from. So let's take a look at Tesla. Oops, that's not Tesla. There we go. Okay. So I did highlight that big 232.5, 252.5 call spread. I think I did it on the live stream. I know I did it on Fast Money. That whoever put that trade on, by the way, they killed it because they bought whatever more than 31,500, because at least 31,500 of those call spreads traded on a single print. That was an outlay of about $10 million. And that thing, obviously went pretty, went all the way to 252.5 and beyond. So that was $20. Obviously made a lot of money there. I did say last week, I have to say, that I have begun to wonder whether, believe it or not, General Motors. So General Motors has got their investment in Cruise. Let's take a look at General Motors for a second. And it's just hard for me to get my arms around how different the valuations for these businesses could be. So General Motors, of course, legacy automaker, plenty of problems. None of these legacy automakers have figured out how to build EVs profitably the way that Tesla has. I'm going to leave BYD out of it because BYD is based in China. Completely different economic reality for them to produce cars there. They were also a battery company before they were the car business, so very well positioned. And Elon himself has suggested that they're arguably the one that Tesla should be most concerned about. But pay attention to the following. At its current valuation, round numbers, General Motors has got a $50 billion enterprise value. Okay, so call it $6 billion in cash, $50 billion enterprise value. And it's generating $11 billion in free cash flow. So it's trading 5 times free cash flow and much less versus next year. If these numbers, that's pretty cheap, okay? And let's compare that instead with Tesla, which, their numbers were better than expected, obviously. But, you're looking at $2.8 billion in free cash flow full year, 6.7, which is still less than General Motors. So remember, General Motors next year, 8.1, Tesla 6.7. Tesla's, of course, going in the right direction. General Motors, not so much. But the enterprise value of Tesla is $822 billion. And General Motors is 50. I mean, this is a huge valuation gap. And Cruise, now I'll disclose this. So a good friend of mine works for Cruise here in San Francisco. And I mention that because when he tells me about the things they're doing, I feel pretty excited about it. And obviously they had that sort of misstep with the Cruise EV that suspended their self-driving thing here. They had, if you don't know the story, a pedestrian ran in front of some cars, got hit by a car that a person was driving, and when they were struck, they were thrown in front of one of Cruise's autonomous vehicles and then struck by that car. And 2 things came out of that. There was a big financial settlement, which you would probably expect, but they also suspended their activities. But now I have not been driven around in one of these things without anybody in the front, but when I say fully autonomous, I mean there was nobody in the front of these cars. They were commonly driving around. I think they were allowed to do this between 10:30 at night and 5 o'clock in the morning, something like that. But I do know people that use these things and got around that way. Is it Waymo, which of course Alphabet just threw more money into? Is it Tesla? No, but does it deserve a discount as big as this? I mean, they're generating free cash. It seems like they're on the right track. Super Cruise, which they do offer in some GM vehicles, is probably one of the best. So, I don't know. To me, General Motors feels like fresh capital, new money, might be worth a speculative bet to the long side relative to Tesla. And that's from somebody who was talking about Tesla on the long side going into earnings. It's just that we've had a big run. I mean, in the meantime. Look at this. I mean, even net of today's $7 decline, stock's trading 262.5. It was at 270, and it was only, whatever, 220, 225 a week or so ago. So it's had a nice run. I don't know. You can be the judge, but I think it's so we should be thought of as an AI robotics. Tucker D Dog says we should be thought of as an AI robotics company. If you value Tesla as just an auto company, it's just the wrong framework. I 100% agree, because if I thought of it only as an auto company, I would be screaming short it, which I'm not. What I'm saying, though, is that they are not the only company that are developing technology in autonomy. In this area, I'm only talking about autonomy, not robotics. And I think General Motors might just represent decent value on a standalone basis. Trades at a huge discount to the market. They have some technology that is proprietary and that appears to be quite good. Is it worth 10 billion, 20? It's hard to say, but they're in the hunt at least, and they're trading at a huge discount. That's the only observation I would make. Okay, so there are two overlapping gaps. And as Carter has said many times, gaps tend to be filled. So, tend to be. I mean, I'm trying to think of concrete examples when gaps were not filled. We have this area right here. That's what you're referring to. And it's not just that we have that unfilled gap. It is also, this looks like a rather challenging area to me that we're in right here. And again, I'm a Tesla fan, right? So we've had a couple of these things. We were going to have one more. Didn't end up getting that Tesla truck, but so I'm a fan of the company. I'm a fan of the technology. Big fan of their products. If you haven't driven a Tesla, you should. If you've not driven an electric, and by the way, compare it side to side to other EVs. My wife won't use the self-driving stuff, and she's the one that drives the Tesla. But they made some recent modifications to it, and I promise you that within the next week, it is my intention, when she's not paying attention or using that car, for me to take the thing out and have a go, because I'm very curious to see what that's actually all about. But okay. Palantir. Oh, yeah. So I think we talked about Palantir last week. Oops. I've got to get back. PLT. There we are. So Palantir, this one feels a bit stretched and extended to me, the valuation. If on a would you rather basis, do you rather Nvidia trading 35 times forward with a 40% growth minimum? Palantir's in the right place. They've got government contracts. I think I showed this chart before, which I'll do right now. These things over here on the right-hand side in gray. So this, this is the Department of Defense. These are various agencies within the Department of Defense. And oops, sorry. Did not mean to do that. Almost no, even the UK's government, as we can see here, that's one of their biggest ones. And they also sell into the contractors, which is key. So you could hardly imagine a better customer base. You could hardly imagine a services business being in a better spot than Palantir is right now. We also have very good growth. But very good growth is not the same thing as extraordinary growth. So what we're dealing with here is solid double-digit top-line growth. And the bottom line is probably going to expand more rapidly, as is typically the case. But compare and contrast that. So this thing is trading 100 times full-year estimates for next year, which is one of the things I was pointing out last week. And compare that with NVIDIA, which I know everybody says, oh, NVIDIA is so expensive, and look how expensive the stock is. Well, I mean, how expensive a stock is a function of how much you're paying for future earnings. And the company is forecast by the street to make $4 a share, as we can see here, next year. This is round numbers, so their calendar year and fiscal year don't line up exactly, but let's just call it $4, right? So $4 on 140 bucks a share is 35 times forward with a 44% growth rate. Expensive? Well, I'm not going to tell you it's cheap, but I don't know that it's expensive. It looks pretty reasonably priced to me. $91 billion in free cash flow. So, the services business, here's one point I would make, though, in favor of Palantir. So as I talk out of both sides of my mouth, see that? I should be a politician. The one thing about Palantir is it's more services based, and I tend to feel like services businesses have more consistent, a more consistent operating performance over the course of time. NVIDIA has no competition, though, right now. Not really. But ultimately, you have to expect that somehow, somewhere, somebody is going to come in and begin to compete with them. And when they do, those extraordinary margins and phenomenal growth rate that they have both should come in. So that's the knock on NVIDIA versus Palantir. But if we look at everything else, just taking a look at next year's earnings, next year's growth rates, in the area of data services and consulting versus the machines that are actually crunching those numbers, feels to me like NVIDIA is a little bit better valuation, if we can say that, despite the fact it's close to being the most valuable company on the planet. I mean, it's running neck and neck with Apple right now. Is SoFi a good call candidate 3 to 6 months out? Is this stock heavily shorted? Okay, so that's a really good question to ask yourself in each case. So the short interest right now is almost 19% of the float. And there's a couple data companies that rank whether or not a stock is at risk of a squeeze. So S3 is one of those data companies. And they have 3 scoring categories, 1 to 39, basically no risk of a short squeeze, 70 to 100. These are crowded shorts, and there's a substantial risk of a short squeeze. 40 to 69 are securities that are becoming crowded and have a moderate risk of a short squeeze. So 65 is at the upper end of that becoming crowded range. The Market, which is another financial market data company, they've got it scored at a 2. 0 is low risk. 3 and above is considered high risk. So is it high risk? No. Is it a risk worth considering? Yes. 20% of the float? Sure. So these are things that are worth paying attention to. I imagine most of your brokerage platforms do permit you to see the short interest. And you can see obviously that the stock has sort of broken out sharply here. And this was after being all but left for dead, but it finally rounded the corner. And but this also, one of the reasons I'm pointing out this chart is I just want everyone to sort of see this is how far this stock has fallen. So if you look at it on a short-term basis, so you just go back 1 year, you say, oh my goodness, take a look at it. The stock's up from 7 to 11. It's up $4 on a $7 stock. But if you get a longer-term perspective, you begin to recognize that in the course of the company's own history, it could potentially go substantially higher. And in terms of operating, so full year 2025 estimates, $2.8 billion on the top line, The last time, let's just take a look at those all-time highs and see how big the company was when it achieved them and compare that to where we are. So this was back in February of 2021. So how much has the company grown since February of 2021? Well, the answer is quite a lot. I'm going to actually go back to 2019 here, but you're looking at about 500 million a year in revenues, and we're at 2.8 or so forecast for next year, I think. Yeah, a little over actually. So sevenfold. The company, if it achieves these top line numbers, the company will be 7 times larger on a revenue basis than it was the last time it enjoyed those high levels. So a very different story. One other thing, that's why I like to look at price to sales sometimes. It helps us give some scale for that kind of thing. And I've just been advised that I've been chewing up the clock a whole lot, so probably have to call it at this point. But we're going to be back here on Wednesday at 4:15. And if you guys have any stocks in particular that you would like me to address on that live stream, you can try to pop them into the live chat while it's still going, but I think the live chat stops as soon as this live stream gets cut. So just throw them into the comments on the channel. Hit the like and subscribe while you're at it. But throw those tickers in there. And by the way, I encourage, I would assume that most of you watching care somewhat about what's going on in the presidential election. And of course, there's going to be a diversity of thought and opinion. Keep it reasonably civil if you decide to comment in there. But I'll leave you with this thought. And that is that I recently heard somebody say, and I repeated this to the New York Times reporter I was talking to earlier today. And that is that, we don't all have to agree. And in fact, we won't. It's not possible. But we do need to talk. And I encourage it because I feel that too often people only talk to like-minded individuals. So everyone's in an echo chamber. And this is true, basically across the political spectrum. I am an independent. I have been an independent since I left college and have supported politicians on both sides over that course of time. I'm not particularly enamored of where we find ourselves, but I will leave you with this one thought, and that is that, society, economies too, are more fragile, I think, than a lot of people would imagine. And they become even more fragile as rhetoric sort of gets more spicy and that dialogue ends up not happening. So I encourage it. And I really look forward to seeing all of you guys again on Wednesday at 4:15. Thanks for watching.